I'm Taylor Vick, and this is the Real Estate Fund Insider. We're pulling back the curtain on how to grow wealth and passive income through real estate investment funds.
I think getting invested in prop tech is a great idea. So when people go out to invest in prop tech, I mean, they're obviously not going on to E-Trade and buying stock, and even when they do invest, it can be very different than like a very established company or something, right?
When you're investing in an early stage technology company, like you said, you're not going to have all the traditional financial metrics to decide, all right, is this a good cash flowing business? Does the EBITDA look good, et cetera? And so when you don't have those metrics, it makes it hard to come up with a valuation, right? So what the industry has done to kind of simplify this is they came up with a document called a SAFE note, which stands for Simple Agreement for Future Equity, which is very similar to a convertible note. But it's only a couple pages and makes it really easy to invest in a company. And what that does is it says, hey, we can't quite determine what the valuation is today, but what we'll do is once institutional investor or a venture capitalist comes in and puts an actual price on that, then your equity will convert at either that valuation, or if the valuation is above what we call a valuation cap, then you would get kind of a discount on that cap. So it's a little bit technical, but it's actually really easy and straightforward. You invested via SAFE, so
Right.
You can probably speak to that if it was an easy instrument.
Yeah, so I guess SAFE Note came out of Y Combinator, right? So the most respected, well-known incubator program in the world. Along with having a lot of innovative companies come out, they've also come up with innovative ways to invest, which have now become industry standard, like the SAFE Note. So the way that I kind of think about it is, okay, I'm going to put in $50 today. We don't know what this company is worth at this time, or it's very difficult to value. Someone else eventually is going to come in once the company is more established and easier to value, and they're going to say, this company's worth $1.25 a share. Because I got in early with the SAFE Note, I get a discount on what they buy at. So they had to buy at $1.25 a share, but I get to buy at $1 a share. So basically my $50 turns into 50 shares, where if I went to buy it directly, it would be less. Once the valuation is created, it allows you to buy at less than what the value is, right?
Yeah, exactly. It just makes it a little bit easier, so you don't have to go through all the, attorneys to draft up really long, investment agreements, et cetera. So it makes it so that you can invest quickly and safely, no pun intended.
And then what, for an investor, when can they get their money back, or what are like liquidity events, or kind of what, if an investor's going into this, when should they expect to get their money or a return in these types of investments?
Yeah, so these are long-term investments, right? So really, if you're a high-growth technology company, you're mostly focused on growth and less on kind of on profit, but that's starting to change now that people are taking it a lot more seriously, and we take it very seriously.
Right, but you're not paying out dividends. You're using that money to pour back in the company.
Exactly. Yeah. So especially not at the early stage, you're not paying out dividends. That's for much more mature, kind of slower growth companies.
Yeah.
So where the liquidity event comes primarily is if there's an acquisition, if there's an IPO. And then oftentimes, as you're scaling up to maybe the A, B, C round, you could potentially sell in what we call a secondary market, where another investor wants to get into the company they want to invest, and you say, hey, I might want to take some chips off the table, and you sell some of your shares to another investor. So that's another way.
Gotcha. So what is the ABC round?
Yeah, so you get some pre-seed funding, you can get some seed funding, and these are kind of typically in the pre-revenue stage, more the idea stage.
So that would be like the SAFE Notes, things like that, in the
so SAFE Notes
pre-seed?
are typically in the pre-seed, seed, sometimes leading up to a Series A round. And then Series A is once you have product market fit, like we talked about, usually in the neighborhood of $500,000 to $1 million in annual recurring revenue, which is subscription revenue. So once we get there, that's kind of like the next milestone, and then the venture capital world has a very kind of clear path as to what metrics you need to hit the next stages.
Gotcha. So yeah, when you're investing, if I guess within the life cycle, you've kind of got this pre-revenue seed stage. So that's going to be your safe note. And then once you hit, I think you said $1 million in annual recurring revenue, right? Which people call AAR, right? That's kind
ARR,
of ARR, sorry. Kind of the industry term. Then you're looking to do a Series A round where you're selling direct equity, and those safe notes convert into equity at a price lower than the A round. And then, B and C are additional raises, right? And then, anything could happen, but you could keep running the company and, maybe pay dividends, get acquired by another company, get bought by a PEG, private equity group, SPAC or IPO. Is that kind of some of the exit?
Yeah, that's exactly right. And as like an individual or angel investor, you're typically going to be investing at the seed stage, because once you get to that, $1 million in ARR, the valuation is going to be much higher probably than what you would want to invest in at, and the amount of capital invested in companies like that is in the 10, 20, $30 million range. So you want to get in early so you can get a meaningful percentage of the company.
Gotcha. And you mentioned, in addition to ARR, other metrics that the industry wants you to hit that are pretty laid out or pretty standardized. What are some of those that investors should look for or want to see their investment company achieve?
Yeah, so once a company fully goes to market and starts with their sales and marketing, you're going to want to see growth, like a growth rate of 2x, maybe they double year over year.
Wow.
So that's in the early stages, and then that kind of slows down a little bit, because obviously once you grow more, it's harder to compound like that.
I think Warren Buffett said it's a lot easier to double a dollar than it is $1 billion. So,
exactly. Yeah.
You're kind of just getting in there, getting the market exposure.
Yeah, and another key metric is retention, or some people call it net dollar retention, right? So we focus a lot on that, in the sense that we could just blast this out there and get a bunch of users who are interested and customers who are interested in some of the data, and they just use it kind of as a resource, right?
Mm-hmm.
But those customers are going to be a lot more likely to churn off because it's not a core part of their business. So that's where we've been really focused on, is how do we kind of insert ourselves into these companies and become kind of a core vital role in their business. That makes our product a lot stickier.
Yeah.
It helps the company, and we don't have as much churn, and meaning that customers leave, right? So churn is something that a lot of people don't really look at, but it can kill a company pretty quickly if you're not careful.
Okay, so you've got, I guess first off, you kind of want to believe in the dream, the product, the founder. Then you want to see $1 million in ARR, because at that point it's something that can be valued at some level. After that, you're going to want to see them go to market with their product and achieve 2x growth for a year or two. And then after that, you're going to want to see how well they retain their clients, or kind of the stickiness, how making sure people stick with the product. Is that kind of a good overview of some of those metrics?
Yeah, so you would go to market well before you get to $1 million in ARR. So you would want to kind of maybe double, hit 100,000 in ARR, then the next year you go to 250, et cetera, until you can get up to that $1 million. But by the time you hit $1 million in ARR, as an individual investor, it's going to be much harder to get into a round like that and invest in a company like that, because at that point the top VC firms are going to be just swarming.
Gotcha. So individual investors need to get in on that early stage before the big guys want to write the big checks.
Yeah, exactly. And as a startup founder, when you're still in this either idea or kind of early revenue traction stage, you're out trying to convince investors to invest in your company and lay out the vision. But once you start to hit that $100,000, $500,000, $1 million ARR mark, the tables kind of turn, and then the investors start kind of pitching you.
Yeah.
So we hope to get to that point, but we're not quite there yet.
Gotcha. And then one last thing there, I know at least in South Carolina, there's some tax benefits, tax credits. What are some things outside of the deal itself that can be good, beneficial to investors?
Yeah, South Carolina has a great angel investor tax credit where you can get up to 30% of your investment in the form of a tax credit. Then you can obviously sell those tax credits for actual cash at usually 80 to 90 cents on the dollar. I actually invested my own money into Infill and was able to be an actual angel investor and reap the benefits of those tax credits for myself, which was a really good opportunity.
Yeah. So at least in South Carolina, if you're set up right, instead of having to wait for a major liquidity event or something like that, investors can actually realize a portion of their capital back in the first year, through tax credits, either applying them against their state tax obligations or monetizing those credits. So that's, I think, one thing great that South Carolina is doing is, hey, yeah, you're taking this investment, it's long-term, it's risky, but look, first year, you're going to get something back. I think it's a great incentive for people to invest.
Yeah, exactly.